Thanks for tuning into Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm joined by Brandon Rakszawski, Director of Product Management at VanEck. Brandon, welcome to the show.
Thanks. Great to be back.
Brandon, I want to talk to you today about moats. For the people who have never heard of the term, can you tell us what a moat is?
A moat is all about identifying quality in a company. Really, it comes down to assessing a company and determining whether they have established an economic moat around their business. Just like a castle has a moat to fend off the enemies, businesses can essentially build an economic moat to fend off competition, hopefully well into the future. And that's the goal of identifying moats, is finding those great companies that have built something that can stand the test of time.
That's great. So what are some examples of moats?
Yeah, so Morningstar, who has really embraced and pioneered the concept of identifying economic moats, has identified a handful of different sources of those moats, and I can touch on a few. There are phenomena in the market such as switching costs. Very straightforward concept where one business can ingrain themselves so deeply in their clients' business models that is very difficult for their clients to switch to another provider. Software companies are a great example of companies with switching costs. Intangible assets is another great example of a source of economic moats. Brands, something like Starbucks, that has built such a brand that company can essentially charge just a little bit more for their cup of coffee than their local competition. Or in another source of intangible asset would be a patent. Many pharmaceutical companies benefit from this intangible assets source of moat because they have patents on all of this drug portfolio, and it allows them to charge more than their competition because, frankly, they just don't have competition yet. So the list goes on, but those are some examples of how a company might attain an economic moat.
Fantastic. It certainly sounds like moats are something that you want in the companies that you invest in. So Brandon, how does this all fit into your ETF, the VanEck Morningstar Wide Moat ETF, ticker symbol MOAT? Does it buy companies that have moats?
Right. So the ETF MOAT tracks a benchmark from Morningstar that essentially packages some of the best ideas within the US wide moat rated universe. And the index, in a very systematic way, essentially selects from approximately 140 US companies that Morningstar has assigned its most exclusive wide moat rating and allocates to a subset of those each quarter that signal attractive valuations. So just as important as identifying companies with economic moats, it's allocating to those companies that are also attractively priced, because logic tells you great companies, investors want to own them, right? So their prices might get bid up and often trade above their fair value. So this strategy is all about isolating those wide moat US companies that are also trading at attractive value. And those two inputs to the index's methodology, identifying great high quality companies with moats, as well as those that are attractively priced, has really been what has driven excess returns both this year and over its long history of more than 10 years in the market.
So Brandon, I checked the latest performance figures, and MOAT has beaten the S&P 500 by around 600 basis points over the past 5 years, 90% versus 96%. Do you think that type of outperformance is possible moving forward? And on the flip side, what could go wrong?
That's a really very timely question, because the strategy, it's meant for long-term investors, and that's what we talk about with all of our investors in our MOAT ETF, is that if you're looking for exposure to the US equity markets, large cap blend is generally what you're getting with this type of strategy. But if you only want it for a few months, if you want to express a view on equity markets, MOAT is not the ETF for you. You can get super cheap beta ETFs, and that's the best course there. But over long periods of time, the strategy has consistently provided excess returns. The longer you hold the strategy over time, the higher the percentage or the odds that the strategy will outperform. So, we've seen very impressive long-term performance numbers posted by this strategy, but that hasn't come without some of these short-term headwinds. We saw that a little bit through the second half of this year, where this strategy outperformed very strongly in the first half of 2023, gave up a little bit in the third quarter, but it's bounced back very strongly. So we think that if you you hold this strategy over long periods of time, more often than not, the experience has been very favorable for the strategy, which is an exception when you're talking about the large blend US equity space. I think it's very well documented that it's very difficult to beat the S&P 500, and the strategy has managed to do so.
Fantastic. Well, we're going to have to leave it there. Brandon, it's been a pleasure having you on the show. Thanks so much for your time.
Thank you.